Hey everybody, my name is Jade, and today I'm going to be talking to you a little bit about how markets become inefficient. So in order to talk about how markets become inefficient, we need to talk about what we mean when we talk about economic efficiency. So, when we say that a market is efficient in economics, what we really mean is that the quantity demanded of a certain good or service is exactly equal to the quantity supplied. So here we have our standard chart space with our quantity on the horizontal axis and our price on the vertical. We have our standard supply and demand curves. With standard supply and demand curves, we have one point in the chart space where these curves intersect, and that point is our equilibrium. So at that equilibrium point, the quantity demanded of a certain good or service is exactly equal to the quantity supplied, and we call that the equilibrium price, EQ. Now, that equilibrium quantity occurs at one specific price, so we call that EP, equilibrium price. This is also called the market clearing price. The reason for that is that it's just that. It's the price where the market's going to clear. There's going to be no extra goods demanded, no extra goods sold, no shortage, no surplus. Exactly all of the goods and services in the market that are produced will be demanded. So this is what we mean when we say economic efficiency. So now that we have established that, we can talk about how markets become inefficient. Now, one of the key ways that a market becomes inefficient is through price controls. Now, essentially what price controls are just a limit that's being placed on the price of a good or a service. For our purposes, when we talk about price controls, we're talking about the price of one good or service at a time being controlled. And these are price controls that are imposed by some sort of law. So this doesn't include things that you might think about, maybe price discrimination, things like that, different prices that come about because of monopolistic practices, things of that nature. These are price controls imposed by law, and we'll look at some examples in just a minute. So there are a couple different types of price controls. Price controls can be either maximums or minimums that are set on a price, and that determines whether or not they are price floors or price ceilings. So let's first talk about price floors. Price floors essentially are just a minimum price that is established for a certain good or service. So an example of this would be something like the minimum wage, right? So the minimum wage, once it's established, essentially says that for the service of labor, laborers cannot be compensated any less than the rate of, say, $10 an hour. So price floors, as well as price ceilings, as we'll see in a minute, can be either binding or non-binding in nature. So binding price floors are those that are set above equilibrium, and we'll see why that is in just a minute, whereas non-binding ones are set below equilibrium. Now, when we're talking about price controls and we say non-binding, what that means is that the market can correct itself back to equilibrium on its own. So non-binding price controls are not really something with which we concern ourselves because the market will just correct for them. So they won't end up dominating the marketplace. They won't end up holding the market in any kind of inefficient position. So that's our price floors, and then we have the exact opposite as well, our price ceilings. Price ceilings are a maximum price set for a good or a service. So an example of this would be something like rent control. So again, just like price floors, price ceilings can be either binding or non-binding in nature. They are binding when they are set below equilibrium, and they are non-binding when they're set above equilibrium. And we'll look at an example of each in just a minute. So again, non-binding, the market can correct back up to equilibrium on its own, whereas binding will hold the market outside of its natural equilibrium. So let's look at some examples. Let's talk quickly about non-binding price floors and price ceilings, even though they wouldn't really ever be imposed because the market corrects for them. So let's start with a non-binding price floor. As I mentioned earlier, price floors are non-binding when they are set below equilibrium. And here is why that is. So say we have our standard supply and demand again, we have our familiar chart space, and we have a price floor denoted PF. And we set it below the market's natural equilibrium. Well, what's going to happen is we're going to have our quantity demanded greater than our quantity supplied. So the thought process on the part of the producers is going to be, wow, a lot of people are demanding this good. We better ramp up our production. So the suppliers are going to start to increase the quantity supplied. And as the quantity supplied increases, so does the price. And because of what the law of demand tells us, there's an inverse relationship between the price and the quantity demanded of a good or a service. So as suppliers ramp up their production, increase quantity supplied, price will increase, decreasing the quantity demanded. So our market is just going to correct right back up to its natural equilibrium point here. So that is a non-binding price floor. Price floors stop the price from falling below a certain limit, and the market is not going to naturally move further out of equilibrium by dropping the price. So it doesn't really concern us. The market is not going to drop below that rate because it's just going to correct back up to equilibrium. There's nothing stopping it. The same can be true with a price ceiling. This is a non-binding price ceiling. As I mentioned before, a price ceiling is non-binding when it's placed above equilibrium, and the exact same thought process and intuition holds here. A price ceiling stops a price from rising, but in this situation, we're not really worried about the price rising. It's not going to fall further out of equilibrium naturally. Markets will naturally tend towards an equilibrium. So in this case, the thought process, while it's the same structure, is a little bit backwards. So in this situation, we have the quantity supplied greater than the quantity demanded. And the producers in this case are going to be thinking, okay, well, not very many people are buying this good. We better slow down our production because we're not selling enough. Now, as they decrease the quantity supplied, the price is going to fall as well. And as the price falls, quantity demanded will increase. So these will be working in the same direction, correcting the market back to its equilibrium point. Again, a non-binding price control. So now that we've seen our non-binding situations, let's look at our binding situations. So this is a binding price floor. This is a price floor set above equilibrium. Now in this case, we have a price up here, some arbitrary price. If it's the minimum wage, say it's, $10 an hour here in California. The market will start to correct down to equilibrium, but then it'll get stopped by the price floor because the price floor disallows prices from falling any further, just like a regular floor. It doesn't let you fall through to the ground level because there's a floor. So in this case, it's going to start to correct down, but then it's going to be stuck at this level here. And at this level, we have our quantity supplied greatly outnumbering our quantity demanded. So we have a surplus in the marketplace. Again, example, minimum wage. Now this right here is why a lot of economists are not in favor of raising the minimum wage, because it's going to hold the market even further out of equilibrium, and we're going to have a surplus of the good, which in this case would be labor, which would be more unemployment. So in this case, quantity supplied greater than quantity demanded. Now we have an inefficient market. We don't have a market where the quantity demanded is equal to the quantity supplied, and the market cannot correct back to that equilibrium quantity on its own because it's being held by a price floor. Now the same can happen with a price ceiling. So here if we look at a binding price ceiling, this is a price ceiling set below equilibrium. Again, the market is going to start to correct back up. It's going to start to correct up to equilibrium, and it's going to get stopped by this ceiling. The ceilings disallow the price from rising above a certain limit. Just as if, say, you were inside and you had a helium balloon and you let go of it, it's going to start to rise, but then it's not going to float above the roof and into space because there is a ceiling stopping it. So the market will start to correct up to equilibrium and get stopped by the price ceiling and be held in this disequilibrium. Now in this case, flipped from the other case we had, the quantity demanded is what's greater than the quantity supplied, and in that case we have a shortage. So if we talk about our example of rent control again, we have a lot more people who are going out and looking for these cheap apartments than we have actual supply of the apartments. And with something like that, there's quite a limit just to the amount of housing we can have, especially in the short term, because you can't just wave a magic wand and have more apartments for people to live in. So this is again going to hold our price out of an equilibrium. It's going to hold our market in a disequilibrium. So, kind of the logical flow chart here. We have our price control, which leads to a disequilibrium. We have a case where the market is not working at its most efficient. In that case, we have our quantity demanded not being equal to our quantity supplied, not equal to some equilibrium quantity, some market clearing quantity, and that leads us to an inefficient market. So economists are always after efficiency, and one of the key causes of markets not being able to rest in their natural efficiency are price controls imposed by some sort of governing body.